Alrighty, 8 p.m. Eastern, Wednesday evening can only mean one thing. It means my kids have less than 12 hours till they go back to school tomorrow after a bunch of days off. They're not looking forward to it. Um, just kidding. Well, that is true. But anyway, it is Taxes in Retirement Live. I am Andy Panko, moderator of Taxes in Retirement and owner of retirement planning and investment management firm Tenon Financial. Thank you for joining me this evening. Tonight's topic is a good one. I'm just calling it generically, you can see up here, paying taxes. Wah. Nobody enjoys paying taxes, but it is unfortunately a lot more complicated than it should be, than most people realize it is. And it is a particularly relevant topic for people who retire, where you've had a traditional W-2 paycheck your whole life. You probably had most or all of your taxes, both federal and or state, withheld from your paycheck. You stop working, paycheck goes away. Now you're no longer, you may not necessarily be having any taxes withheld anymore. So you might be on your own to figure out how and when to pay taxes, and it could catch people by surprise. So we will discuss that all this evening. Dad jokes. Let me give you those before we get started. Dad jokes for the evening. All right. If Apple made a car, what would it be missing? Windows, of course. The first annual meeting of Camouflage Club was a disaster. It looks like no one showed up. Couldn't see him even if they were there. And finally, my wife gave me an ultimatum. It was her or my addiction to sweets. The decision was a piece of cake. What can I say? It was that good. That kid loves my jokes. Someone does, thankfully. Let me check comments. Ooh, Dave Fultz mixing it up. No longer just howdy or ahoy. Last week was ahoy. I realized after the fact that was probably because I had a shirt that made me look like a French sailor of sorts. So maybe that was the reason for the ahoy. Today's just greetings, period. But again, I love that it is a full sentence. Dave Fultz, a one-word full sentence. One other thing I just want to mention for the fun of it, I'm trying to lose a little bit of weight. I'm telling you all because you can help keep me accountable. I figure if I put it out there to the public, it'll make me more incentivized to actually try to stay on track and do something. Weight's been slowly creeping up, especially over the summer. Lots of, this year more so than previous years. Seems like we're kind of making up for lost time with summer gatherings and being around people and eating and drinking. So lots of burgers and beers and desserts and other garbage, and weight just kept ticking up a little bit. So I am, as of Monday morning, 176.1 pounds, 5'9", for those of you who are interested. My goal, I've been, comfortably in the 160s for years, and finally just kept creeping up this last year or so. So my goal is to get to 165. That's definitely doable, and I'd like to. Maybe even 160, though that may be a little too thin and light for me. But anyway, I'm putting that out there to the world. So you all heard it here first. I will update you all every week of what my Monday's weight was. So I will be embarrassed, and hopefully that'll prevent me from not letting myself go if I keep the half coming here, every week and announcing my weight and it's going up. So anyway, 176.1 pounds this week as of beginning of Monday. I will do the same every Monday. All right, disclaimer before tonight. This video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. I am just some guy here on Facebook tonight talking about estimated tax payments and withholding taxes and underpayment penalties on taxes. Super exciting stuff. Okay. Mary Sherwin, treadmill while you're live. I should get one of those little foot things under the thing. My issue isn't exercising. Actually, I exercise aggressively between long bike rides, running, elliptical, go to the gym multiple days a week and lift some weights, nothing crazy. But my problem is eating and portion control. Like to eat. When I'm on a roll, good, bad, or otherwise. So, especially with the summer, like I said, being around people and burgers and desserts and hot dogs and whatever, it just blah, 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 blah. Anyway, so I still work out a lot, but I eat more than I work out. I'm not in calorie deficit by any means. cut back beer. Yeah, I'm not a huge beer guy, but when I do, it's been like every weekend for the last month or two. It seems like we've had something to do, which usually involves lots of food and drink. So, all right, I will stop boring you with my rambling about my weight loss goals, but let's get to it. So, estimated taxes, withholding taxes, tax penalties, etc. I have some slides I will pull up. It's probably the best way to go through it. I'm sure there'll be lots of little sidebars and things that rabbit holes we take down tonight's journey, but I will try to keep it to a coherent discussion. Okay. As always, questions we'll try to save them to the end unless it really seems like it's relevant for what someone's saying. I'll pop it up here on screen. But so let me start by saying this, and tonight is all in the context of federal income taxes. For states that have income tax, which is most of them, not all, but most of them, the processes could be different, the deadlines could be different, etc. So this is purely federal income tax tonight. Although most states do loosely follow a structure like this, those that have income tax, not all do. So I'm not saying anything about states tonight, purely federal tax. It's on you to figure out your state taxes and if they follow the same sort of process and what's not. So it is important to know that there are 3 ways to pay federal income tax. There could be more. I'm boiling it down to 3, but one is have taxes withheld. So for those of you that work and get paychecks, you know what this is all about. You simply have your employer just take some money right off the top, send it straight away to the U.S. Treasury and or your state Department of Taxation, whatever they call themselves. So you can have taxes withheld from paychecks, from Social Security, from pensions, from annuities, from IRA distributions. There's not a lot of other things. There's gambling winnings you can have money withheld from. Certain other government payments, like I think unemployment compensation, you may be able to have taxes withheld from. But for the most part, for the vast majority of you all watching, it'll be one of these sources of things will be your only likely your only means of income from which you can have tax withheld and sent directly to U.S. Treasury. Second option, make quarterly estimated payments. I'll get into that more. Third option is just simply wait until you do your tax return. You have to file it by April 15th, typically. The last 2 years have been oddballs, but normally it's April 15th or the next day if it's a holiday or whatever. But just wait, don't pay any tax throughout the year. Wait till you do your tax return. Pay it all with your tax return by April 15th. I do not recommend this. There are some exceptions in times where that's okay, which we'll touch on. But for the most part, do not do this. You have to pay taxes throughout the course of the year. Don't wait till filing your tax return and pay it all because you likely will have an underpayment penalty. I'm just looking at this. Yeah. So Dave Myers saying option 4, just randomly send in money. Yeah. I mean, you can go to like the IRS website. I think you need to specify what the payment's for, and you would say estimated payment. If you just send a check to U.S. Treasury, put your name on it, I mean, I guess maybe it'll get there eventually, but that's asking for trouble. So I'm lumping number 4 in with estimated payments, Dave, and 5 carry over from previous years. Yeah, I thought about that. Those are technically treated as if they're estimated payments made in the first, or functionally treated as if they're estimated payments made in the first quarter. So I left that one off, but that could be its own, I guess. If you do have a refund due, or you have an overpayment on your tax return, you can apply some or all of that overpayment to next year's taxes, which functionally is just like making a first quarter payment, basically. But I'll touch on those estimated payments more. Okay, so these are the 3 ways, quote unquote, asterisk, maybe 4th way to pay taxes. So it's really just the first 2 is what you're going to do: estimated payments and or paycheck tax withholdings. Let's start with withholdings versus estimated payments. So the U.S. income tax system is what's called a pay-as-you-go system. In theory, you're supposed to pay tax on income, on money, as you earn it or as you receive it. And easiest way to understand this is like with your paychecks again. You get paid every 2 weeks while you're working. You have taxes withheld directly from that. You're paying as you go. You're paying as the money's earned. So that's easy. That's easy to get. It's a little different when your income's lumpier or you're no longer employed and you control where your income comes from, like IRA distributions or whatever. Then you need to start paying more attention to this stuff. So as I mentioned before, we're going to assume there's really just two ways practically that you're going to pay taxes: withholdings or estimated payments. Paying taxes through withholdings is safer and easier, and I'll explain what I mean by that, than paying through estimated payments. So to the extent you can make withholdings as opposed to estimated payments, I would generally recommend doing that. Here's why, for the most part. Here's kind of the top level reason why. When you do withholdings, recall I said it's a pay-as-you-go system. You're supposed to make your payments or withholdings as you earn the income. But with withholdings, it frankly doesn't matter when in the year you have that money withheld. As long as you withhold the proper amount at some point during the year, you're good. So one extreme example, you get paid every 2 weeks for the whole year. You withhold nothing through the first 25 paychecks of the year. On your 26th paycheck of the year, you decide to withhold, let's assume your tax bill for the year is going to be, I'm making a number up, $20,000 of federal tax. In your last paycheck of the year, you withhold $20,000 from that December 31st paycheck. That withholding, even though you made it on the last day of the year, as opposed to sprinkled throughout the year, you're good. If that's enough to cover your year's tax obligation, fine. The timing of withholdings does not matter. The timing in the year when you make them does not matter. That's a big, big benefit to withholdings. On the other hand, if I'm looking at the bullet now, if you make estimated payments, timing in the year very much does matter. So right there's more planning and thinking you have to do with making estimated payments as opposed to making withholdings. Now, all else equal, you're supposed to take however much tax you have to pay throughout the year through estimated payments. You're supposed to take that total amount, break it up into 4 even chunks, and make those 4 payments in each of the 4 quarters of the year. And I'll detail what those quarters are and what those dates are. If you don't, you may be subject to an underpayment penalty by not paying. So you can't just make one big fat estimated payment in December if you had income throughout the year. You're supposed to know for the year what your tax is going to be, break up those estimated payments into 4 chunks paid throughout the year. If you can possibly annualize your income, which is if your income is lumpy and or unknown throughout the year. So you can't at the beginning of the year guesstimate when your income is going to happen or how much it's going to be. You can pay it quarter by quarter, pay estimated taxes for the income earned or realized in that quarter. It takes a little more work on your tax return to do that, to quote unquote annualize your income, as opposed to making 4 equal estimated payments. But nonetheless, this is an option, which I will touch on a bit more. Okay. How to figure out your estimate. Let me hide this. Your tax withholding. So the IRS does have a pretty slick calculator. You got the web link right up here, and here's just a screenshot of what it looks like when you go to the site. You would say use a tax withholding estimator, and it'll ask you a series of questions. Are you married? Are you single? How do you file your return? Do you have a pension? Do you have wages? Does your spouse have pension or wages? Whatever, and just walk through the prompts. It's pretty good. Not bulletproof. There are trying to figure out your taxes, projecting your total taxes for the year isn't an easy undertaking. If you only have one source of income and that income is purely wages and that's it, sure, this is a pretty simple, straightforward process, and this tool will work marvelously. If you have lots of other random sources of income, like capital gains, lots of dividends, you sell a rental property, you get some other sort of big payment or distribution from something, you're going to struggle to estimate your taxes properly. There are tools. Again, this tool is one thing to help. There's another worksheet I'll show you that can help, but it's hard. Shy of working with a knowledgeable tax return preparer, or having your own like TurboTax or other sort of tax prep software that lets you model around stuff and play around with things, and you know what you're doing in that software, it's going to be difficult to do this for most people. But nonetheless, this is one tool to try to figure out your withholdings if you have sources that can be withheld. Again, wages, pension, annuity, Social Security, IRA distributions, gambling winnings. I might be missing 1 or 2 others, but those are going to cover, for the vast majority of people, all the sources of possibly withholdable income. Estimated payments. This is when things start to get a little funky. So do you need to make estimated payments throughout the year? This is a function of a few things. What is your total taxable income going to be? What are your withholdings going to be, if any? And what are your other tax credits going to be, like the this coronavirus stimulus payments last year were tax credits. So you need to, this is where things get difficult. If you're going to get credits like child tax credits, earned income tax credits, coronavirus stimulus tax credits last year, you need to know those and what they're going to be when you fill these things out, so you can help narrow in on, what your estimated taxes are going to be for the year. Like I said, this could be tricky, but I'm trying to keep this all as intelligent and sensible and digestible as possible for tonight. So follow this flow chart. There's something called the safe harbor. Safe harbor is basically, so long as you pay at least X amount of tax throughout the year, you won't be penalized at the end of the year if you end up underpaying. So I like this little flow chart. This is from IRS publication 505, which is the IRS publication all about making estimated payments and tax withholdings. A lot of great info in there. Definitely refer to that for those of you that are interested in this stuff and want to learn more. But this little flow chart nicely maps out those safe harbors and helps you figure out if you need to do this. So just simply starting here, and this is 2021, again, just federal taxes we're talking about. I'm not talking about anything state related tonight, but state taxes do apply if you live in a state that has income tax. So let's start at the top. Will you owe $1,000 or more for 2021 after subtracting income tax withholdings, if any, you make, and refundable tax credits from your tax? Don't subtract any estimated payments yet. So what does this mean? So at one extreme, if you're low income or low taxable income person, and even if you make no withholdings, if you end up that your total tax obligation for the year is $1,000, is less than $1,000, you do not need to make any estimated payments during the year. You'll still have to pay that tax at tax return time. You'll have to pay that less than $1,000, whatever your total tax is, but you will not be penalized for having not paid any tax during the year, because this is viewed a sort of de minimis amount of tax owed. They're not going to nickel and dime you to hit you with like an underpayment penalty on a $500 tax bill for the year if your total tax bill is under $1,000. If it's $1,000 or over, again, net of withholdings. So let's go back to the example I just gave. First example was your total tax obligation for the year is $800. It's under $1,000. Boom, you check yes. You check no to this. Follow down that arrow. It says you are not required to pay estimated taxes. Done. What if your total tax obligation for the year is going to be $10,000, but you're withholding $9,500 from paychecks or whatever? That means your net amount of tax you're going to have after withholdings would be $500. That's less than this 1,000. So follow the arrow down. No, there you go. You do not have to pay estimated tax payments. But what if, same example, your total tax obligation is going to be $10,000, your withholding is only going to be $1,000. So now you have a $9,000 total tax obligation for the year. So in reading this box, you'd have to answer yes. So now you move on to this one. Will your income tax withholdings and refundable credits be at least 90% of the tax return on your ultimately 90% of what your total tax is going to be? Now, in parentheses, there's some oddball exceptions for farmers and fishermen, different rules. I won't get into those. For everybody else, simply says, is the amount you're going to withhold plus your tax credits going to equal at least 90% of what your total tax obligation is going to be for the year? If the answer is yes, then scroll down or look down and boom. No, you do not have to pay any estimated taxes. So I think I gave you a bad example last time. I said if your total tax obligation was $10,000, you withheld $9,000. I think I said $9,000. Yeah, right. Whatever. I don't want to confuse you. I probably should have had some examples for this, because otherwise, the more I talk numbers, the more people are going to get lost. So just know that if your total withholdings for the year will cover at least 90% of what your total tax is going to be for the year, you do not need to make any additional estimated payments. So one example, you're going to have a $100,000 total tax obligation, but you are going to withhold $90,000 against it. You meet the safe harbor. You're withholding at least 90% of your total tax bill for the year. So therefore, follow down this yes. You do not need to make any estimated payments. But in that same example, total tax bill is $1,000. You only withhold 80. So you're only withholding 80%. Now you got to answer no. Now you move on to this next one. This one basically says, okay, fine, you're not withholding at least 90% of this year's total tax bill, But what if this year's withholding is at least 100% of what last year's total tax bill was? If you're withholding at least 100% of last year's taxes, then follow down this yes. Okay, you do not need to make additional estimated payments this year. There's one little asterisk here, or actually the double asterisk. That 100% level is a little higher. It's 110% if you were high income, specifically $150,000 of gross income last year. If it was 150 or more, then you need to withhold 110% of last year to meet this safe harbor. If you do, then you don't have to make any estimated payments for the year. Finally, if you don't meet any safe harbors, so the 3 safe harbors are: you're going to owe less than $1,000 of total tax. You're going to have less than $1,000 of total tax obligation. So you're not meeting that, or you're not withholding at least 90% of what this year's taxes will be, or you're not withholding at least 100% of last year's taxes, or maybe 110% of last year's taxes if you were over 150 grand of gross income last year. Then you do have to make estimated payments this year. If you don't, you will be subject to an underpayment penalty. I'll pause there. I thought this was a really clean, simple sheet. And as I was talking through it, I was like, wow, there's a lot going on here. So does that all sink in well enough for now? Cool. All right. Next. How do you estimate your estimated taxes for the year? I refer you to IRS publication 505. There's a worksheet, specifically worksheet 2-1. There's a lot going on here, but if you walk through it, it's not that difficult. For those at home, you may have to scroll in to see this, or just go to publication 505. It's all there for your perusal. This is loosely similar to that IRS website I mentioned. This is used to estimate your tax withholdings. This is cool because it's all interactive. You click, 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 push buttons, and done. This is conceptually similar. You answer a lot of questions, put in projections and estimates for yourself, but this is in worksheet form as opposed to like a neat interactive tool. So you do kind of have to grind through this manually. There may be spreadsheet versions of this out there somewhere, I don't know, but you can just do this manually if you want. So long story short, you put in your gross income, put in your deductions, you figure out some of your other taxes and credits, you put in how much you're going to withhold, if any. This is what tests for those safe harbors I just mentioned. So if you want to look at the nitty-gritty details behind this summarized little decision chart I just looked at, this is the actual sort of math and more detailed stepped through logic of this calculation process. So if you go through all this, fill it all in, it'll tell you, in essence, do you meet a safe harbor? If yes, then okay, you don't need to make any estimated payments. If you do not meet a safe harbor, this is a sheet that will calculate what your total estimated taxes are or should be for the year, and it'll say break that up into fourths and pay that throughout the 4 quarters of the year. Good. Quick question. So yes, this person, is the $150,000 exception for both married filing joint and single? Yes, it is. And this is in reference to that prior year's safe harbor. So if you're withholding this year at least as much as 100% of last year's total tax, you meet that safe harbor. Unless your gross income for last year was 150 grand or more, then the safe harbor level is 110%, not 100. If you look at this footnote here, it's just simply it's 150 period. The only time it's different is if it's 75,000 if your filing status is married filing separate. Another way where married filing separate often isn't in people's interest to do, because it's typically more punitive in its treatment of credits and thresholds and things like that. So no, whether you're single or married filing joint, it's 150,000 last year is the threshold. Good question. Alrighty. We did that. So if you do need to make estimated payments, when do you have to do it by? Surprise, surprise, the IRS does not use calendar quarters like one would logically expect. They have their own IRS quarters. So the 4 quarters, the first one is 3 months, which makes sense: January, February, March. So that first quarter's payment is due 15 days later, by April 15th. The second quarter is only 2 months. The second quarter is only April and May. It's not April, May, June. So second quarter's taxes for April and May is due June 15th, 15 days after that quarter ends. The third quarter is 3 months: June, July, August. Its payment is due 15 days later, September 15th. Note, We are September 8th. For those of you making estimated payments and you need to get one in by the third quarter, you have 7 days to get it in until it's September 15th. And then finally, the fourth quarter is 4 months, September, October, November, December. That payment is due 15 days later, January 15th of the following year. So fourth tax quarter 2020, its estimated payment is due January 15th, 2022. If you're mailing it, the date it's postmarked is considered the date received. So if you're making a payment by September 15th, let's say, get it postmarked by September 15th, you will have met the cutoff. If you make it online, it's the day it's actually submitted / accepted. I guess submitted. There may be some technical thing between submitted and accepted, but I just made my own quarterly payment to the IRS yesterday. And, as soon as I hit submit and acknowledge that, that's the date, if you will. It was yesterday was my payment date. And then if any one of these days is a Saturday, Sunday, or legal holiday, then the date is the next day that's not a Saturday, Sunday, or legal holiday. So I think, actually, if I remember correctly, January 15th payment next year is actually due January 17th, because 15th lands on a weekend or MLK weekend or something. I'm not sure. But I want to say it's January 17th, 2022, not the normal January 15th. There are estimated payment vouchers you can do. For those of you that use tax return software, it'll often generate for you estimated vouchers for the year. Now, all that's doing is just taking like your current year's tax return, assuming everything's going to be the same next year, and it'll spit out for you estimated payments based on what your income was, the prior year. So that may not work for you if your income's going to be more or less, but nonetheless, it'll give you vouchers that way. You can get vouchers online. I don't have a link to it, but just Google IRS estimated payment vouchers. If you want to mail money in, you can print off a voucher that way. But frankly, the easiest, safest, cleanest way is just to do it online. I don't have the website here, but just Google IRS estimated tax payment. I assume it's secure. I mean, it's no less secure than anything else you do with your life online. You can pay by credit card, which I don't recommend doing because there is a fee. I think it's 2.9%. So avoid that. You can do for free, for no additional charge, ACH transfers from a checking or savings account, and that's what I do. And the money goes over, done. There's all electronic record of it. I don't have to worry about it getting lost in the mail or anything like that. So anyway, that's what I do, but to each their own. You can mail it in if you want to. So these are your estimated payment dates. Federally, again, states usually follow these guidelines, but again, check with your specific state because it can very well be different. All right, underpayment penalties. This is probably why most of you came here tonight, not to watch me talk about my weight or talk about dad jokes. So underpayment penalties. Recall I said that the U.S. income tax system is a pay-as-you-go system. The intention is, as you earn or recognize your gross / taxable income, the IRS expects you to make your tax payments on it at the time. The big exception was withholdings. If you're making withholdings of tax payments, the time in the year you make it doesn't matter. You can withhold your whole year's taxes on January 1st, December 31st, or any combination of days or amounts in between. You're good. You don't have to worry about the timing. So that's why I said withholdings are cleaner and easier, safer. I don't remember what words I used. Some of those combination of words than making estimated payments for that reason, because there's no timing to have to worry about at all. So these underpayment penalties really apply in the case where you did not withhold enough, and or the estimated payments you made were not broken up in 4 equal amounts, or they weren't enough, or your income was lumpy and you didn't annualize. So point is, if you don't pay as you go, as the IRS is expecting you to with your estimated payments, they can charge you a penalty. Now, penalty sounds like a harsh word. They call it a penalty. It's really just interest. All they're doing is charging you interest on amounts you should have paid by certain dates but didn't. So it's not the end of the world. Lots of people have penalties all the time. I've had penalties myself, sometimes tens of dollars. One time a handful of years ago, before I really started paying attention to this stuff and got into this, a couple $100. So not ideal, but not the end of the world. If you underpay your taxes by a few $1,000, your penalty is not going to be hundreds of dollars. It'll be tens or dozens of dollars. It's when you have tens of thousands of dollars of taxes that you shorted the IRS by, then you're talking about hundreds of dollars, if not thousands, in interest. But just so you can get a gauge of like what the interest actually is, it's currently 3% per year per annum is what they charge you. It used to be higher. At some point last year, it dropped to 3, and it's currently still 3. Now they can change this. I forget the frequency with which they can change it, but it's been 3% for a while. I suspect it'll stay 3% for a while. I doubt it'll go lower. I think the technical formula is like the Fed funds rate plus 3%. So Fed funds rate's effectively 0 plus 3% to it. So I don't know that can ever be lower than 3%, but who knows? So it is 3% per annum per year, but they only start the clock on your interest accrual by the dates at which money was due and not paid. So for example, let's assume you don't make any estimated payments throughout the year and you were supposed to. It's not like they start charging you interest from January 1st of the year. No, they give you until April 15th to pay what should have been 1/4 of your total estimated taxes for the year. If you did not pay that amount by April 15th, then the clock starts, I guess, April 16th. I could have a day wrong, but let's assume it's April 16th. This 3% per year clock starts from April 16th and runs to the end of the year. So that missed first quarter payment, but you're paying what 9 months of interest basically at 3% per year. So 3% divided by 3/4. I should be able to do this in my head, but why am I not? In a 2.25%. Yeah. So for that 9 months, you'll be paying about 2.25% in total for that first quarter's missed payment. And then same process happens, however much you should have paid by June 15th, the end of the second quarter. If you did not pay by then the second quarter's missed or underpayment, interest on that starts from June 16th and runs to the end of the year. So you're only paying, I'll call it half to keep the numbers even, you're only paying 1.5% total interest on that missed second quarter's missed payment. So you still have the clock running on your missed first quarter payment, but the clock on the missed second quarter payment or the accrual doesn't start until you miss your second quarter payment, which is June 15th. Same thing. You miss your third quarter payment, interest clock doesn't start on that till September 16th. So you can see you're not charged a whole year of interest on any of this stuff. You're charged partial quarters or months of interest. That's why these things aren't over the top punitive. Again, if you're only short a couple $1,000 in taxes, you're going to owe tens of dollars in underpayment penalty. Not the end of the world by any means. Don't be that freaked out about it. Avoid it if you can, but again, don't lose sleep that, oh my God, I can't nail down my tax estimate to the penny. It's okay. It's really hard to, as long as you're within the ballpark and you're okay, possibly having some amount of penalty, don't lose sleep over the fact that it's a penalty. It's not the end of the world. You don't get, it doesn't, I don't think it increases your risk for audit. You don't get put on some watch list or whatever. You just simply, they send you a bill, say, hey, you owe some interest. You pay them, done, move on. Okay, what else do I have here? So how can you possibly get rid of or reduce your underpayment penalty? As I touched on before, there are some circumstances where if you did not make enough estimated payments or you did not pay them at the right times throughout the year, again, it's supposed to be paid equally. So if you're supposed to owe $16,000 in estimated taxes all year, you're supposed to break it up and do 4 payments of $4,000 each. $4,000 by April 15th, another 4 by June 15th, another 4 by September 15th, another 4 by January 15th. Let's say you forget your first quarter payment and you don't make it till second quarter. As I mentioned, not the end of the world. You'll have a quarter worth of underpayment penalty on that. Anyway, so there are some instances where if you don't pay enough, you can get it waived or reduced. One is if you or your spouse filing jointly, retired in the past 2 years after reaching age 62 or becoming disabled, and you had a reasonable cause to pay late. Now, I honestly don't know what all is included in quote unquote reasonable cause. I like to think that you can simply say, I've never had to pay estimated taxes. I've always had a paycheck that withheld taxes. This was new to me. I simply didn't know, so I didn't do it. I hope the IRS waives that. But I don't know. I mean, ultimately, although it doesn't sound fair because the tax code is so overly complicated, the taxpayer, i.e. all of us, the onus is on us to fully know and understand taxes we're supposed to pay and when. So I wouldn't be surprised if the IRS doesn't give an exemption in the case of simply saying, I retired, I didn't know I had to do it. Maybe they will. I hope they will, but I frankly don't know. So that then leads me to say, I don't know what the other reasonable causes may be where they would let you waive it if you retired recently, you're over 62. The other big one that comes up more commonly probably is the annualized one. So people who, let's say you're a consultant, you're a freelancer, at the beginning of the year, you have zero idea what your income is going to be in total, let alone when you're going to earn it. So you can't possibly come up with an estimate of what your total taxes are going to be. Therefore, you don't know what estimated payments to make, and you can't break that up and do it quarterly. As I touched on before, if you do have this lumpy income, you can simply play it quarter by quarter. So let January, February, March pass. By the end of March, you will know what income you earned for those 3 months. You can then figure out, okay, what's my tax going to be on that? Pay that by April 15th, by that first quarter estimated payment. Do the same process for the second quarter. Again, second quarter is only 2 months, April and May. So by the end of May, you'll know what your income was for April and May. So then pay tax based on that by June 15th and do the same for the next 2 quarters. Then come tax return time, it will be a little extra work because you will have to actually math out the annualization, or basically just sort of recognizing, okay, I had this much income in this quarter, this much in this quarter, this much in this quarter, this much in this quarter, and therefore I paid this much tax in this quarter, this much in this quarter, blah, blah. If you properly did your math along the way and paid the right amount of tax for each quarter, this annualization method will reduce or completely remove any underpayment penalty. The IRS will waive it. They'll say, okay, fine, you didn't pay 4 equal payments. We get it. Your income was lumpy. You matched up your tax payments with your lumpy income. Cool. Where this would also make sense, I think I saw a question here, like Roth conversions, for example, more common for retirees than gig freelance work. So let's say you have Social Security, you know what that is. It is what it is. Shows up every month. Let's say you have a pension, you know what that is. You have a little bit of dividend and interest income. You don't know exactly what that is for the year, but you can get a reasonable estimate based on prior years and what they were. But you didn't plan on doing any Roth conversions this year. So let's assume you withholding from your Social Security and your pension enough tax to cover those things and your little bit of dividends and interest. So right there, you're good for the year. You don't need to make any estimated tax payments. But fourth quarter rolls around, stock market drops 30%. You're like, oh yeah, let me get some Roth conversions in while this is a good time to do it. Stocks are low, convert, get more bang for your conversion buck. So you do $100,000 Roth conversion. Well, guess what? In January, you had no idea you were going to do that. So it wasn't feasible for you to guesstimate that you're going to have this income. Therefore, you didn't know you need to make estimated tax payments. So guess what? Surprise, you get $100,000 of extra gross income in the fourth quarter. What do? Don't be concerned. You simply make your estimated tax payment for that quarter. So by January 15th, based on however much additional tax you're going to owe due to that $100,000 conversion, then come tax return time in March or April, you will have to do this annualization calculation on your tax return to show that this fourth quarter estimated payment was because you had a big fat extra amount of income in the fourth quarter. That income wasn't realized equally throughout the year. To do that, I mentioned here, but I forgot to say it. Form 2210, this is the form that calculates the underpayment penalty and or lets you do this annualization calculation. For those who aren't annualizing, let's just say you underpaid your taxes, knowingly or otherwise, you don't have to calculate the penalty. The IRS gladly does it for you. You simply do your tax return, send it in. Maybe you get a refund, maybe you get an overpayment, I don't know. But when the IRS gets it, they will figure out that, okay, you did not pay enough throughout the year. They will calc the underpayment penalty for you. They'll send you a letter, typically a few months after the fact, could be delayed at this point because the IRS is so backed up. But they will send you a letter, say, hey, you owe us $17 or $82 or whatever the payment is, the penalty is, pay it. You can question it if you think they're wrong. If you know they're wrong, yeah, you can question it. Yeah, you can push back. But my advice is, if it's tens of dollars, if it's $100, just don't fight it. It's going to be more time and effort, especially if you have to pull in someone to represent you in front of the IRS. You're easily spending hundreds of dollars, if not thousands, depending how complicated this proofing process is. It's not worth it, right? If it's going to cost you $200 to save yourself this $100 the IRS is asking from you, don't do it. Just pay us $200. Move on with your life. It's the path of least resistance. All right. Anyway, I think that's it. Yeah, final thing. So this is publication 505, just to show you what it looks like. I've mentioned lots of times before, the IRS has lots of great, what they call publications. It's really surprisingly well written in most cases, kind of plain English, educational summaries about the things you need to know about various aspects of the tax code and paying taxes and tax returns. This particular one, publication 505, is about tax withholding and estimated tax. So this is where I got all my, the tables and stuff from today. Definitely references for those who are interested. All right, I am done with my slides. Let me go to questions. I will stop my screen share so you can see me fully in all my glory. And let me scroll up to the top of the question list. Don't mind me reading through questions. Mary Sherwin, does an ACE, Affordable Care Act subsidy reimbursement via federal tax return count toward estimated tax payment to avoid penalty? I think so. That's a tax credit. I think so. The only reason why I'm questioning myself is I'm looking at my safe harbor flow chart and it's saying refundable credits, not non-refundable credits. For what it's worth, ACA tax credits are not a refundable credit, meaning they can't take your tax obligation below zero. They can take it from something to zero, but not below zero. But still, I think ACA credits or any other tax credit would come into play. Just looking at this worksheet. I don't know the answer with certainty, though. Mary, good question. Arbitrage opportunity. Pay estimated tax in January. Roth conversion with a large paycheck withholding in December. Yes. Right, exactly. Again, the timing of withholdings does not matter. One trick may not be ideal, but one trick you can do if you realize throughout the course of the year, oops, I'm short with my tax withholdings or estimated payments. It's too late to catch up. I can't make estimated payments now. I mean, you can, but the damage is already done from missing the other few quarters of estimated payments. You can make withholding. You'd be like, but I only have Social Security. I can't change my withholding that quick. It's going to take a few weeks to change that withholding. If you have an IRA, you can take an IRA distribution and do a 100% withholding to have that entire distribution get diverted to pay taxes, to go towards withholding taxes. That works. That's a withholding, just the same. And again, doesn't matter. As long as you do it at some point that calendar year, cool. So if you find out you're $5,000 short in estimated tax payments throughout the year, you can do a $5,000 IRA withdrawal at the end of the year, withhold 100% of it. So now you're paying $5,000 in federal taxes. The catch is that IRA distribution is additional taxable income itself. So so you got to do some circular math. That $5,000 of IRA distribution you take, assuming your IRA is all pre-tax money, there's no basis in it. That's $5,000 of additional taxable income for the year that further ticks up the tax you're going to owe for the year. So you have to do some math there to fine tune that. But yeah, you can do if you don't have a paycheck, you can do an IRA distribution at the end of the year, withhold all of it. I've done that with clients. It works. They will, depending on the custodian, most should let you withhold 100%. That's a pretty cool trick to make a withholding in a pinch at the end of the year. I did a Roth conversion first quarter, been sending in Atlantic. Cool. I don't know what that means. But I guess maybe Atlantic was a typo. But you did Roth conversion first quarter. You've been sending in estimated payments, I assume, each quarter, or at least you did for the first quarter. And I should mention, the IRS no likey when you pay late as opposed to early. So like, for example, if you're supposed to pay your estimated payments equally throughout the 4 quarters, that you can't just pay all of them in one fat one in the 4th quarter. You can pay all 4 in the 1st quarter. They will gladly let you overpay initially. And what happens is, and this is what I mentioned before when Dave Myers said, getting a refund from your last year's tax return applied to this year's taxes is functionally treated like it's a first quarter tax payment. So whether it's using of a refund from last year's tax return or making an overly large estimated payment in the first quarter, the point is the IRS will only basically count the first quarter's worth, and they'll let the excess flow over into the second quarter. So if you overpay the first quarter or use a lot of your refund from last tax return as a payment for this year, you can front load it for the year. The IRS will let you just kind of spill out and treat the excess payment through each of the 4 quarters. But again, you can't stack it all in the end of the year because they will ding you for having not paid in the previous quarters. Okay. Old McDonald's gets a sweet exception. Yeah, Old McDonald. Yes, he does. Farmers and fishermen. Lots of exceptions and tweaks and unusual provisions in the tax code. When do you get penalized if you underpay? Is it by a certain percent? If you underpay by 10%, do you pay a penalty for not withholding enough? Yeah, good question. This goes to the thing I mentioned before about the safe harbors. This is a little tough to read. I sort of almost wish I just did this in a simple bullet. It would have been easier to follow, I think. But I thought these flow charts was a good idea. In hindsight, maybe not. Yeah. So if you underpay by a certain amount, and again, the safe harbor is if you ultimately withhold in withholdings or make 4 equal estimated payments throughout the year that equal at least 90% of what your total tax obligation is going to be, there's no underpayment penalty for having not paid that additional 10% during the year. Or the other safe harbor, this is the box 2B I'm looking at here. If you withhold or make 4 equal estimated payments totaling 100% of last year's total taxes, or 110% if you were higher income last year, then there's no underpayment this year. So here's a cool example. Let's assume last year you only had a $5,000 total tax bill, right? For whatever reason, super low. This year, you do a monstrously large Roth conversion for $500,000, and your tax bill is going to be what is it? I don't know, $150,000. I'm making up a number. So you can use the safe harbor to your advantage. You don't have to pay $150,000 of tax during the year. Since your total tax bill last year is only $5,000, you can only withhold $5,000 this year. Even though you did a $500,000 conversion, you can only withhold the $5,000, and you will not have an underpayment penalty because you met the safe harbor. Now you will still owe the additional, $145,000 of taxes at your tax return time. It's not that you avoid the taxes; you just avoid the underpayment penalty by relying on the safe harbor if you had a super low amount of tax last year. So that's one thing to keep in mind. Or one extreme, if you had 0 tax last year, you don't have to pay or withhold anything throughout the course of this year. Even if you end up owing $1 million come tax return time, you will not be penalized for underpaying because last year's tax obligation was 0. So 100% of 0 is 0. You meet that safe harbor by withholding 0 this year. But again, you will still have to pay at tax return time. So keep that in mind. As a follow-up to Mary Sharon's question, would a 2021 stimulus payment that was not collected early in the year also avoid penalty? I don't know. I'm not quite following the question. It was not collected earlier in the year. I don't know. I mean, these stimulus payments are credits. They're not income. So if you didn't actually get the credit for whatever reason, would it reduce your income? Would it reduce your tax obligation and therefore reduce your safe harbor? I don't know. That's an interesting and good question. Don't know the answer. Hussein, if you get a pay raise this year, can you reduce your withholding to 0 once you have withheld last year's tax amount and not get penalized? Yes, exactly. So I got ahead of myself. But yeah, this is the same thing I said last time. As long as you cover 100% of last year's taxes or 110%, if you had 150 grand or more of gross income last year, yes, you can stop withholding once you meet that safe harbor. You're still going to owe tax at the end of the year. You can't avoid that, but you can at least avoid underpayment by meeting the safe harbor. Really? Spammer got through? I thought we were good at catching these things. Anyway, so Cody, if you're seeing this, can you please delete this comment and block this fake profile out? Thank you. Which tax form is the estimated payment? Okay, I touched on this. This was a 1040 ESV, I think it's called 1040 estimated voucher. Just Google estimated payment voucher and you'll find it. Yep. Yeah, just made your payment. So when you go online to IRS to make payments, you can schedule what date you want. It doesn't need to be that day you do it. And same thing for state. In my case, at least, I have in New Jersey. They have the same type of setup. I can schedule future payments of my tax payments. Yeah. Cool. Thank you, Cody. What else we got here? If someone receives too much of an advance premium tax credit, do you pay a penalty due to the underpayment of tax? That's a good question. So the question is, people who are on Affordable Care Act health insurance and they get subsidies in the form of these advance paid tax credits. If you end up getting too much of those, what happens is you have to pay it back. come tax return time. Not the end of the world. The question is, if this is the reason why you didn't pay enough tax throughout the year because you got too much credit prepaid to you, could this lead to an underpayment? I think so. Assume yes, just to be conservative. I don't know the answer, to be honest. I'm just making this up. I would think so, and assume so until you find out otherwise definitively that it doesn't. How do they know when you quote unquote earn income if it is mostly Roth conversions, for example? Yeah, they don't. So by default, well, not by default, but the IRS has no idea. When you do a Roth conversion, whether you do 1 or 50 conversions throughout the year, you're going to get a 1099-R from your Roth IRA custodian that year. I guess your IRA custodian will send it. Yeah. Well, and okay. So yeah. So your Roth IRA custodian will send a form to them, saying how many total conversions you did. There will be no mention of dates. So the IRS has no idea when you did those conversions. The assumption, the base case is that that income was earned equally throughout the year, or in the case of conversions, was converted equally throughout the course of the year. That's why they want you to make your estimated payments in 4 equal amounts. So if your total tax bill for the year is going to be $20,000, they're assuming the income belying that tax obligation was spread equally throughout the year. So you're going to have to do your 20,000 estimated payments in 4 equal payments of 5,000. So they assume it's all equal unless it's not. And the only way they know that it's not is if you fill out that annualization thing on Form 2210. That's where you manually tell them, I had this much income this quarter, this much this quarter, this much this quarter. Now, how do they know if you're lying or not? I don't know. Just hope you don't get audited. I don't know if annualizing your taxes leads to a higher audit risk. If they do, make sure you didn't lie about when you actually earned or realized the income. But it is the honor system at that point. But the onus is on you to prove it. If and when challenged, questioned, or audited, it's on you to prove that the income was earned when you said it was. Okay, what else we got? This is a good one. Do brokerage accounts allow withholdings on sale of shares in relation to capital gains? I don't think so. Someone in I don't remember if it was a tax group or a planning group, told me it's possible. In theory, it seems like it could be, right? So there's taxable income. You have a sale, you have dividends or interest. They should let you withhold taxes, and they should send those taxes to the Treasury or to your state. But I called a couple brokers, and they don't. I called TD, which is the custodian where my clients have their accounts, and they didn't. Now maybe they do, and the person who answered the phone didn't know and gave me bad information. But she said no. She's like, nope, it's not an option to have taxes withheld. It'd be cool if you could. And someone else, my wife works at a separate broker, and same thing, looked into it there, and they confirmed no, you can't just randomly be like, I had $50,000 of long-term capital gain realized. Can you please withhold whatever $10,000 and send it to the U.S. Treasury for me? They said they can't and or don't do that. So I don't think so. Maybe you can. Like I said, did have someone claim he or she did it. Now maybe they were lying or they were confusing the question and what they're responding to. But I don't believe this is possible. It'd be really cool if you could. This would be a neat fix to make a withholding in a pinch if you had to. But I don't think it's possible. What else we got? Yeah, Dave Myers saying the same. I've never seen withholding on ordinary taxable income accounts at a brokerage. Yes, but foreign withholdings, yeah, depending on the country and stuff like that, there are some automatic taxes withheld. I think it depends on the country, but to make sure that the foreign government gets their cut of what taxes are ultimately owed on you getting interest from their German security or something. Alrighty, looks like that's it for the questions. Anyone have any other questions? I'll stick around for a handful more minutes, see what pops up. Get rid of my screen share here. Get rid of David Myers' comment. Ooh, Teresa Wood liked the flowchart. Cool, thank you. Yeah, if you sit and read through it, it makes sense. As I'm talking through it fast, I realize it's a little clunky, but it is a very logical flowchart. For purposes of this presentation, though, to flash something to you all quickly, I think a few bullets would have been cleaner, but whatever. Thank you, Teresa, for that. All right, looks like that is it. So next week we got a good one, far outside my wheelhouse. I got Zachariah Schaefer will be in talking about crypto assets. I guess we'll focus mainly on cryptocurrency, but crypto assets in general. What is it? What does it mean? What's blockchain? That's sort of the whole magic belying crypto, and why crypto could really be something. But anyway, he's a younger dude. He's an advisor. He focuses on folks in their 20s and maybe even 30s. So he's not quite retirement guy, but crypto is definitely that's one of his strong suits. So he was kind enough to agree to come on and wax crypto with you all. So definitely, if you have questions, I know I do, show up next week for special guest topic. We got another question. Hold on here. Hussein. Cha-cha. I am receiving the advanced child tax credit. Due to additional income this year, I won't be eligible for child credit based on my 2021 income. How will that affect my withholding? So, yeah, I tried to opt out. So my wife and I are getting some of these. This is a 2021 special. May go into next year as well. I don't know, but child tax credits are usually, if you have dependent children, you get some credit. It's up, what is it, $2,000? I forget. They changed it. They upped it this year, but normally it's $2,000 per child, up to $2,000 per child, and it was paid at the end of the year as a tax credit. Whatever your total tax bill was, just shave these child tax credits off it. That's what you actually owe. This year they're prepaying them, and by default, everyone gets it prepaid unless you opt out. I was successfully able to opt out. My wife was not. There's this whole dog and pony show to confirm your identity. You have to upload to create an account with the IRS if you don't already have one, which I do from years ago when the security was much more lax. Now the security is legit. You got to upload a picture of your passport. You got to look in the camera. They do facial recognition to make sure you match your passport and blah, blah, blah. I could not get my wife's account validated, so I couldn't withhold her half of the child tax credit, unfortunately. But anyway, so we may end up owing some of it back. Yes, if you're not eligible, you will ultimately owe it back at tax return time. So that can and will affect your withholding, in that whatever amount of tax you're going to owe, add to it the amount of prepaid tax credits you have to give back. That's going to add to your payment at the end of the year. And I think the having to refund the government back these prepaid tax credits might possibly be subject to underpayment penalty. I don't know. I'm just guessing. But that may, in effect, be an additional tax payment you have to make. So they may ding you for underpaying that. So to be safe, maybe increase your withholdings. Don't just stop at last year's safe harbor, Hussein. I don't know for sure. I'm just thinking out loud here to be conservative. Maybe juice up your withholdings a little bit, or simply opt out to the extent you can. And the website doesn't block you from making a profile, just opt out of the rest of the year's payments. So there's only been two months of prepaid child tax credits. You can stop the rest of the month, so you don't have to worry about having to pay them back. Anyway, hopefully that works for you. Okay. My 23-year-old has crypto craze. Yes, it's frankly it's a lot of gambling is what it is. I will go on record as saying that. Maybe it'll be phenomenally well long term. Maybe it'll collapse to zero or close to it. But people who think they're crypto traders are, don't get me wrong, lots of people making boatloads of money. It's dumb luck, and speculation and gambling is really all it is at this stage. It's way too nascent of an industry, of a thing, for anyone to claim there's any justified fundamentals behind valuation of crypto assets. And I'm comfortable saying that. Now, next week, Zachariah may say I'm wrong, but I still firmly feel it's nothing but a gamble at this point. So don't fool yourself. If you made money, it's not because you have skill. It's you got lucky. All right. That crypto equals tulips. I like it. The Dutch tulip craze. Speculation, not investing. Oh, true, exactly. El Salvador just accepted cryptocurrency. I forget which one. I'm Bitcoin, whatever, as a national currency, and crypto dropped like 15% that day. All right, I will wrap it here instead of keep rambling. So thank you all for joining. See you next week for Zachariah Schaefer and crypto assets. That'll be a fun one. Take care. Have a good night.